if we look at the behavior of gold and silver in the last, say, 3 or 4 months, both of them look to have put in a clear bottom. If gold reached 5,000 with a 15 to 1 ratio on silver, that would imply $333 silver.
Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Peter Krauth joins us today. Peter is a former portfolio advisor and a 20-year veteran of the resource market with special expertise in precious metals, mining, and energy stocks. He is the editor of 2 newsletters to help investors profit from metal market opportunities. They are the Silver Stock Investor and the Gold Resource Investor. And Peter is also the author of the best-selling book, The Great Silver Bull. We're delighted to have Peter join us once again today. It's time to saddle up and silver up for Peter Krauth. Peter, welcome back to SBTV. How are you doing?
I'm good, Patrick. Thanks so much for having me, and I'm looking forward to our talk.
Peter, your book, The Great Silver Bull, what inspired you or got you to put pen to paper and see through this best-selling book, The Great Silver Bull?
So, Patrick, really it all kind of started, I'm going to say, in mid-2020 when I saw what happened with markets because, of course, of the pandemic and the extreme reactions that came from that, and how gold and silver reacted to how market events basically. And so gold did very well, up 40%, but silver was up 150% from its low in March of that year to its high, which was, I believe, at the beginning of August of 2020. So that was a tremendous performance and even outperformance of gold. And so over the next few months, I really started to think more and more about where we stood in the secular bull market for silver. And to me, it gave me conviction that we were really at the very beginning of at least the second half of this secular bull market, which, in my view, actually started back in about 2001. And so this is, I think, going to be a very, very long secular bull market. We're already 20, according to at least my calculations, say 21 years in, and I think that the period from about 2012 or so till about 2016, when gold and silver went sideways and downwards mostly, that was sort of the middle portion of that secular bull, and that since then things have picked up, and the action in 2020 was basically confirmation of sort of the acceleration phase for silver in the latter part of the secular bull market. So all of that, I guess, that kind of market action got me to think, well, I've done all this research and writing, posting articles and so on gold and silver. And so this would have been March of 2021. And I said, look, we're in the middle of a pandemic. Nobody's going anywhere. Nobody's doing anything. I was busy, but there was a way to work the time in and put the time in. And so I said, now is a great time to put all of this research kind of into one place and explain the opportunity that there is in this silver bull market.
You've stated that silver is your generational opportunity, and what led you to that conclusion?
So assets go through multi-year and sometimes multi-decade bull markets. And I think that for precious metals and commodities, you could argue, so hard assets in general, from about 2000, 2001, have started what I think is a multi-decade bull market. And so just the action, again, really, especially in the past year, when stocks and bonds which are financial assets, have started to really struggle and have had the worst start to, and we're actually now at the end of 2022, but even if you go back a few months, so let's say the first 3 quarters, that was the worst three quarters in any given year for the past century for the combination of 60 bonds, so the standard portfolio of 60 bonds, 60% stocks, 40% bonds, the 60/40 portfolio as it's better known. So that portfolio absolutely, tanked. People were opening their investment statements, looking at the returns and saying, well, how come bonds didn't at least do well? Bonds are supposed to zig when stocks zag, and they didn't. Bonds tanked along with stocks, and that's because rising interest rates is hurtful to both of those asset classes. And so I think that a lot of people looked at that and then said, okay, well, this isn't working anymore. I mean, it's going to take a while. We're talking nearly 40 years of a secular bull market in stocks and in bonds. So that's generational. And so to get people to finally believe or accept that market, that bull market has run its course, will take several years. But I do believe that for commodities and precious metals, that did start about 2000, 2001, and this is going to last a long time. And people are starting to look for alternatives. And certainly, if you look at how silver is priced historically, based on its pricing, going back decades, if you look how it's priced versus gold, if you look how it's priced versus all kinds of other assets, stocks versus oil versus housing, for example, silver is extremely cheap. I mean, frankly, the only other asset that I could say is perhaps in the same category, hard asset, would probably be uranium. And I'm a bull on uranium as well. And so, silver having its dual purposes of being both money and an industrial metal, to me, gives it an exceptional and a unique, well-rounded place in our lives. And so, and silver's been money longer even than gold, going back 4,000, 5,000 years to Mesopotamia. So silver's been used and known as money, and it really has been in our money. And these are the kinds of things I talk about in the book, that silver's been money for us, for most of the world, for thousands of years, up until at least about 50 or 60 years ago, in the 60s, when silver was removed from coinage, mostly in the West and elsewhere. So we're really living an experiment now where we have an unbacked currency, and especially the US dollar, the reserve currency for the world, arguably, that is not backed by anything. That's really an experiment, and my bet is with the proven commodity.
More on that in just a bit. You said the word money, and you're a believer in that money is the greatest invention in history. What is it, or what meaning or qualities of money that makes it the greatest invention in history?
These are things that I talk about in the book, and I say that, and I don't say it lightly, but I say that because the advent of money in history made it so that people could really advance much more quickly in terms of how they did transactions, and allowing people to do transactions more easily helps them to concentrate and to focus and to specialize. And so by being able to do work that you're good at, that you have perhaps, let's say, some kind of an advantage at, you specialize, you do that work, you accumulate, let's say, a certain asset, whether you're a farmer and that's wheat, or whatever it might be. And then you can, instead of having to trade whatever you've produced for some other good that you want from someone else, you have to find that person. The two of you have to agree on, what each your assets are worth. These are not things that are easily accomplished. But if instead you can sell your what you've produced for this widely accepted tradable asset, silver, for example, and then so you sell your whatever you've produced, you take silver, and then you sit on it until you need to trade it for something else. And really, it's a store of value, and it's a method of transacting. So you have this stored value, and then you decide, okay, now I need something else. I either need a service, I need some other good, and then you turn around and you take that silver and you use it to exchange again for this other good or service that you want. But the key thing with money is that it needs to reliably store value over an extended period of time. And we're seeing that if you look at what today is the world reserve currency, the dollar, the US dollar, that's not the case. If in the span of a century, it's lost something like 97% of its value. So, if you had, I'll give you an example. And I did the calculation to look at what silver was worth a century ago. So in 1922, silver was 63 cents, I believe, an ounce. And today we're north of, say, 23, $24. So if you compare the math and the growth or the inflation rate versus the growth in the value of silver, so official inflation in the U.S. over a century has been around, say, 3%. And silver is actually, so that would bring silver to about $11 or $12 an ounce if it had followed the official inflation rate. And silver is really a double of that. So despite the fact that silver is cheap compared to other assets, and I believe extremely undervalued and underpriced, it still has doubled the official US inflation rate over a century. So you would have, rather than have a dollar in 1922 and still have that same dollar today, which would buy you 3 cents worth again, rather than a full dollar's worth, silver would buy you $2 worth today. So you'd actually have doubled the value of your buying power over time. It really shows how, and to go back to your original question about why, silver or sorry, why money is, such a great invention. Um, it has just facilitated so much of what we do on a day-to-day basis, dealing with each other, transacting with each other, receiving something that until about 50 years ago, at least, you had confidence that, okay, I can sit on this asset for an extended period of time, and I can know that I will take it back out of my drawer or wherever I'm storing it, and I can turn around and use it again to exchange it for some other asset. And so the ability to do that has just allowed, I think, civilization to flourish, because again, we've been able to specialize. We've been able to deal with each other with a certain level of confidence, taking money, reliable money in exchange. And so that has allowed technology, medicine, and all these different areas of life to simply flourish.
If you're enjoying this interview with Peter Krauth and I, please consider subscribing to our YouTube channel. Let the algos know you'd like to see more content like this. And if you'd like to learn more about systemic wealth protection, please do visit us at www.silverbullion.com.sg. Yeah, it's a great point there on how you talked about civilizations flourishing. On the flip side, today, where we see all of this money debasing, the dollar losing its purchasing power, and history tells us that when these things happen, nations or empires, they do fall, where citizenry or civilization actually starts to fall or fail. Are we getting to that point with all the debasing and printing going on?
I don't want to be too negative, but I hate to admit it, but I do believe we're at the very least heading in that direction. Something else that I talk about in the book is in reading a book called The History of Interest Rates by Sidney Homer. And he shows, I think it's 5,000 years of interest rate history. And so that's just tremendous. There's nothing comparable to that. And what he noticed is that over time, as a society progresses and matures and becomes more sophisticated, interest rates in that society tend to go down. But what he also noticed is that eventually stops. And at some point there's a turning point and interest rates start to go up, and that has meant that that society really has kind of peaked. It is sort of living off of its largesse. It's starting to, use democracy as a way to dole out and buy votes, to, provide goodies for everyone in exchange for votes. And so we're really looking at sort of the peak in that civilization, and it starts to be a degradation. And it's early days. But I believe that what we've seen in the last year, in fact, it's just in the last year when the Fed and other major central banks have started to raise rates after 40 years nearly of rates falling. So we're talking about 1980. Um, that to me really does look like this kind of turning point that Homer talks about in his book, and it's unfortunate, but you do see serious degradation over time in societies when the interest rates start to rise, and we don't have to look. Back 5,000 years, we could look back 2,000 years and arguably, or a little bit less maybe, but when Rome began to fall, that was kind of what I think scholars agree economically at least, was the first sort of, big civilization, that sophisticated civilization that had reached its peak, and interest rates started to go up. They debased their money. None of this is new. We've seen this, and it's just unfortunate. It's actually quite sad. We don't seem to be learning from history, and we're repeating it.
I want to go back a bit where you touched on how silver was money. And I want to go back to where US President Roosevelt's Executive Order 6102, which many people, rightly or wrongly, simply refer to it as a Gold Confiscation Act. It's pretty well known. Yet there was another act very little know or followed, which was the Executive Order 6814. Can you tell us about the little known Executive Order 6814?
Yes. So that is I guess you could call it in quotes a bit like the Silver Confiscation Act. Silver was part of the coinage, and so the government was running low on silver, and did something similar. They did not confiscate the money that had silver in it. That the idea was actually to try to help produce more money. So they needed silver, and they asked the population to turn in their silver, and they started paying silver miners and producers a slightly higher amount for the silver that they produce, so they could actually have it all go to them instead of to others. And they turned around and used that to help produce more silver coinage and help boost the money supply. But you're right. This is very similar to the, in quotes, gold confiscation, and had similar effect. I can't remember the number, but there were, millions and if not hundreds of millions of ounces of silver that were turned in, and that lasted for the effect of that lasted for decades. But again, that's also a little known, very comparable kind of act by Roosevelt.
Right. So I guess during that time, we were, in fact, as you stated in the book, we were on a de facto silver standard.
That's right. Exactly. Exactly. And if you look at, as I say, silver over history, it has been money since before gold was. I think, part of it probably has to do with relative value. So, gold being considered more valuable. It's sort of easier to use pieces of silver to pay for smaller transactions. But silver historically has been involved, because of that, has been involved in more transactions over, let's say the last 4,000, 5,000 years. And so has technically, in that sense, been more important as money than gold has.
You see silver perhaps getting to $300 an ounce. I hope it gets there. What factors will we see along the way to get silver to that number, or what do we need to see to get silver to that number?
The first thing I do want to say is that I think, that's my upper end target. And I do think that that's the kind of number that silver could reach in a speculative mania. It's not necessarily the kind of number, although nobody really knows, but it's not the kind of price level that I think it will go to and necessarily maintain for an extended period. That being said, um, uses for silver are expanding on a daily basis. I mentioned before, it's about half of its applications are as money, but the other half are industrial applications, which we can talk a little bit more about in a minute or two. But in terms of silver reaching that kind of a high, uh, in the book I talk about multiple ways that I got to the number of 300 for silver as a peak number. And what I did was I looked at multiple indicators. One of the sort of best known ones would be the gold silver ratio. And so I looked at what has happened historically and then said, okay, well, if we project forward with certain assumptions, what would that mean for silver? So, the gold silver ratio bottomed around 15 in 1980 when gold hit 850 and silver reached $50. So that was I said, okay, what would happen if the ratio went back down to 15 again? So the one you do have to make an assumption other than the 15, and that is what the gold price would be. And so I've been saying for over a decade that I think gold would ultimately reach at least $5,000. And if we've been at 2,000 twice already in the last couple of years, I don't see 5,000 being two and a half times that being unrealistic, at least not anymore. And so if gold reached 5,000 with a 15 to 1 ratio on silver, that would imply $333 silver. So I thought, you know what, that's very specific. A round number is, it's more of a range. 300 in that case, slightly lower to me meant more realistic or relatively achievable. I also looked at what happened with, say, housing prices. And again, this was in 1980. And then there was actually a peak in housing prices in the ratio versus silver back around, I believe it was 2001 or so in that time frame. So it went from, I believe, around 14,000 silver ounces to buy the average home in the US in 1980. And that went up to about 55,000 silver ounces when silver went down in price and home prices kept going up around the early 2000s. And so I projected using that ratio once again, and I said, okay, let's look at numbers currently. The average US house price is about $450,000. If you do 15,000 silver ounces, what would silver have to be? And that brought me to a price somewhere, I believe it was again north of $300. So I said, okay, on that basis, we're again around 300. There are a couple of other ratios and indicators that I use that I detail in the book. And each time I looked at these different ratios, it always brought me to a range that was somewhere close to $300. I think another one of them was the Dow to silver ratio, and that actually went down in two waves to reach a bottom. I believe that was around 24 was the ratio bottom in 1980, and looked at projections for the Dow going forward and reaching a similar low, and again it reached a price target for silver around the $300 range. So again, these are all detailed in the book, but each time, as I say, I looked at different potential indicators and ratios. I always got to a price somewhere near 300, and so that made sense to me, and figured maybe that means something. Maybe it's a sign that silver could ultimately reach somewhere near that level.
All right. I guess I'm going to have to buy more silver then to meet those goals. We have inflation, we have rising interest rates. Why are we not yet seeing the upward movement silver had in the 70s and 80s?
So that's a very good question. Obviously, everybody's asking themselves that, and I think that what we've seen over the past year is that silver has been like any asset. Buyers choose to allocate. They make comparisons and they make decisions, and they've been seeing bond prices rise because interest rates have gone up. So short-term bonds have seen their yields rise. That has made them relatively attractive compared to other assets. So if you can get, let's say a 2-year treasury that pays you upwards of 4%, maybe 4.5%. That's quite attractive. Now, to be fair, it's a negative real return if interest rates are 8% or even 7%. So people are actually losing 3% on that trade. But in terms of safety, and not everybody makes that calculation or takes that into account. And so, investors will look at that and say, do I go with the relative safety and lack of volatility, let's say, of a 2-year treasury paying me 4.5%, or do I put some money into silver that's obviously volatile and has been in the past few years bouncing around a fair bit? And so it's not that different from the decision they've made of gold, let's say, versus treasuries, or even just sitting in US dollars in a money market account. And you could probably make, a couple of percent on that money, where as little as a couple of years ago, you were lucky if you made 0.1 or 0.2% on that same money. So it looks tremendously better. But again, at net of inflation, you're still losing money. So I think that's turning around. If we look at the behavior of gold and silver in the last, say, 3 or 4 months, both of them look to have put in a clear bottom. Gold is up about 11% since its, I believe, October, November low. Silver has been up at above $24, has been up 35% from its September low, which is more than a 3-to-1 outperformance of gold. And it actually bottomed, interestingly enough, it actually bottomed before gold did, about 2 months before. So silver really is looking attractive, starting to catch up. And again, something that I talk about in the book is that silver in secular bull markets, or in clearly definable bull markets, at least precious metals bull markets, silver always outperforms gold. And so if you see silver today still considerably cheap and undervalued and underpriced versus gold, to me, it's not to say that you should buy silver at the expense of gold. It's just that you need to absolutely consider and hold at least some silver for the upside potential.
Also in your book, you quoted where Milton Friedman once said inflation is a form of taxation that can be imposed without legislation. And then you also quoted former Fed head Alan Greenspan, where he said that in the absence of gold, there is no way to protect savings from confiscation through inflation. There is no safe store of value. So on one hand, we had Friedman saying we are being taxed without legislation, and then we have Greenspan saying without gold, perhaps silver, our savings are being confiscated. Is it fair to say our money is taxed and confiscated pretty much right now?
I mean, yes, for sure. Uh, it's. I think that, and I'm not sure that it's been fairly attributed to him, but I believe it was Lenin who said that, one of the best ways to overturn a society is to debauch the currency, and so, by inflating away, you create havoc, and I'm not going to go into the argument of whether it's intentional or not, but I do believe that it does bring about that kind of effect. And we talked about that at the beginning in terms of a peak in terms of society, in terms of the quality or the lifestyle in a society. And so yes, by inflating, the buying power is being reduced. You could argue being stolen, and so one of these quotes also in the book says how, I think it was Keynes actually who said, not one in a million. It's such a subtle way of reducing the value of the money, that not one, or of taxing, that not one in a million actually really truly understands what's going on and how that effect comes about. So yes, that's absolutely what's happening, unfortunately.
Knowing this, what should we do? What should we do to protect ourselves from, I guess, the government, from, I guess, the central bank? And maybe could you share what you're doing?
Sure. So, it's very interesting that probably many of your listeners, if they follow this space somewhat, know that in the third quarter of this year, central bank gold buying, was off the charts. It was more than any entire year since 1967. And central banks have become net buyers of gold since 2009. So if you look at that, I mean, I'm certainly of the view of do as they do and not do as they say. So if you do as they do, they have plenty of, I think, very timely, accurate information. And so if we see central banks loading up like this, then they know that it's making more and more sense to hold physical precious metals. They're buying gold. Naturally, it's an easier thing for a central bank to store because of the inherent value in an ounce of gold versus, let's say, an ounce of silver. But an ounce of gold is obviously a multiple more expensive, 70, 80 times more expensive than silver for an ounce. That being said, I think that it makes sense that investors, everyone really, should own at least a little bit of physical metals. Silver makes a lot of sense. I think silver is going to be a beneficiary of this bull market when people watch really what happens to gold. And that, I think, is part of the reason that silver does well, especially in the sort of later phases of its bull market, because it takes a while for people to realize, understand, and accept that we're in a bull market, let's say for gold, and that it's not going away. And so they eventually buy into it. But when they look at gold, and let's say, you're talking a couple of years down the road, and gold is two and a half, $3,000, and they say, oh, well, a few years ago it was just 1,500 or 1,800. That's too much. What else can I do? What are my alternatives? And silver is the natural alternative to that. And even if silver is, say, 30 or $40 at that point in time, it's going to look a whole lot cheaper, and it will be, of course, per ounce than gold is. And I think that people will actually start to buy it and load up on it at that point in time. And that's going to help drive what is likely to end up being some kind of a mania in the asset, as we've seen in the past. It's likely to repeat. It's just unfortunate that so many people really come to these conclusions so late rather than taking advantage now. Not unlike stocks, investors in these kinds of assets will look at them and say, these, and be discouraged by the fact that they're cheap, rather than being encouraged and saying, I'm getting to buy this at a discount, right? They wait for it to run up, and then they because of fear of missing out, the FOMO effect, which I also talk about in the book, has brings them to run towards the asset and many times overpay. So, uh, you know, I really do try as hard as I can in the book to lay all of this out, and I think I do a reasonable job of presenting the picture, the opportunity, and how you can position and take advantage. Really, what we need to be doing is become our own central banks, not rely on how the economy is being managed, so to speak, by them, which is an impossibility, much too complex. Um, and rely on ourselves and become our own central banks by owning at least some physical metals. But and then beyond that, start to look at this space, and they don't need to take outsized risk. I give a few examples also in the book about how some of the largest silver companies, and that's either on the royalty and streaming side or on the producer side, have had amazing runs of 1,500, 1,700%, in some cases in a matter of just 2 or 3 years. It's incredible how some of these lowest risk players in the precious metal space, silver in particular, have had outsized returns. So, you don't need to go and play in the highest risk. I do think it's interesting for many people to play in the junior space or even the mid-tier space, because the leverage is just incredible. And there's ways to account for the volatility that brings, and again, all of that's detailed. But even by gaining exposure to some of the biggest names, you get tremendous leverage. And I think that, once you own a little bit of physical, that makes absolute sense. And, the even the large gold and silver miners right now are so underappreciated. They're at amongst their lowest PEs. They've converted from being net debt to positive in terms of cash. They've switched over from being bad allocators of capital to being tremendously good at allocators of capital. Some of them are paying as much as 3, 4, 5% yields on an annual basis. Some of these are the largest mining companies in the world, and so if people are looking for value and looking for yield and looking for potential upside, there's really almost no better sector right now to be considering. It's really something people would do themselves a big favor to dig into. I think one of the big things that everybody needs to watch, probably many are watching, are the actions of central banks, just because the influence is so big. But I think that at least the Fed is nearing the end of its rate hiking cycle. I think that's actually why gold and silver has started to take off. I think that they're starting to price that in. The Fed is, in my view at least, likely to stop hiking rates in the first or second quarter, at least somewhere in the first half of next year. And I think the odds are good that there's something is going to break. I mean, we've seen action just a few days ago with the Bank of Japan allowing rates to take off on the longer end of the yield curve. We've seen the problems with pension funds in the UK, and so these are big enough, but they're not huge, or at least somehow they've been controllable to some extent. I think something bigger is likely to happen, and that we could see that in the first half of next year. That, to me, is likely going to cause the Fed and possibly even several of the larger central banks to actually not just pause, but after pausing, start to cut and to stimulate. And I think at that point, all bets will be off, not only for stocks, which I think are likely to continue suffering up until the middle of next year, and we're probably going to face at least a mild recession, if not a regular recession, in the middle of next year. And these things combined with some kind of financial event, and the end to rate hiking is going to cause easing in terms of interest rates, potentially even new stimulus programs if things get bad enough. And I think we're going to see multiple asset classes. Obviously, I'm a bull on silver, other precious metals, and commodities in general. But I think we could actually see stocks and bonds take off at that point, perhaps for a year, a little bit beyond that. I'm not a long-term bull on stocks or bonds, but I think that falling interest rates, in the same way that they've been a headwind for stocks and bonds, they'll actually be a tailwind, and they'll help them rise for a while. But people will start to lose faith because inflation is likely to take off at that point again, because that more easing is going to mean more printing. And that's going to obviously help support precious metals, but it's also going to eat away at confidence in central banks and their ability to handle or control the economy. So I don't think the longer term rallies in stocks or bonds are going to maintain themselves. But I do think that precious metals and commodities will resume a long-term bull market, and that will be the area that people need to focus on. Silver in particular, I think is just so compelling. It's historically cheap versus gold. The Silver Institute sees for this year 16% more demand overall than it did for last year, while supply is only expected to go up by 2%. So we're going to have a 194 million ounce deficit, which is close to, it's just under, maybe around 15 or 16% of the entire market is going to be in deficit in 2022. And they expect deficits next year and for several years into the future. It really, again, is hard to find any asset that is just more compelling, more underpriced, more undervalued than silver. And I think we could see as high as 25 in the first quarter or second or first half of next year. And I think that $30 is not out of the question by this time next year, in 2023. Beyond that, again, as I say, I think that stocks and bonds are going to find some headwinds, but I think precious metals will see the win in their sales and continue very strongly well beyond next year.
Like with what you're saying, especially that word confidence, people are going to lose confidence. And straight away, the thing that popped in my head is uh, the Fed, they are looking to basically make employment a little bit more difficult for people. And so that also is going to double down on the loss of confidence. So I'm kind of wondering here, you got investors losing confidence, you got the average Joe losing confidence, and where are we going to be at that point?
Well, that's great. You're absolutely right. And the nice thing, or sorry, not nice, but the interesting thing is that in the book and in a recent chart actually that I have, the one in the book is, I think, partially the same, and it shows the 1970s how inflation played out, and you had three waves of inflation in the 70s. So the late 60s until about 1970 was the first wave. So what you had was the Fed would step in and react. So of course, like now, they're late. They come to the party late. They decide to raise rates, and that gets inflation to drop. So I'm going to do it in reverse for you because you see it the other way. So the first wave went like this, and then around, I think it was early 70s, the inflation came down, and then so the Fed backed off because inflation came down. But this whole thing was ingrained. It didn't go away. And so jobs were already hurt. There is a lag of about a year in the employment. So when inflation peaks, employment tends to peak a little bit after that. So you see unemployment start to go up as the next wave of inflation comes. So the next wave went even higher. The Fed stepped in, raised rates again. The whole same cycle happened, but and unemployment went up again, and then ultimately things cooled down a little bit. Inflation went back down, and then you had the peak at the end of the 1970s, which was the ultimate peak in inflation, which was absolutely crazy, where you had mortgages at 18%, inflation at 20%, and I mean, I remember it. I'm old enough to remember that people were paying 18% on their mortgages. It was wild, but there's a huge difference between today and then. Back then, the federal debt in the US was 35% of GDP. Today, it's 130%. So the Achilles heel here is that the Fed can, whether they admit it or not, they cannot raise rates more than a certain amount because there is the interest that's due on the massive debt just becomes unpayable without just simply printing money. They will reach a point where they have to print money simply to pay the interest on the debt. And I believe that is the pivot point. That is the turnaround where faith is lost completely, and we really are in this sort of new paradigm. And the peak in precious metals, it's anyone's guess where they will head for from there. But I think that will be the turning point.
Yeah, it's a great point because the other thing we think about is as the silver demand grows, industrial needs it, civilizations need it to advance. Then what happens to the investor? Is there going to be enough silver for the investor to get his hands on?
That's a great point. I mean, if you look at and just one industrial application. So the single largest industrial application is solar panels. So photovoltaics requires 12% of all of the silver supply every year. So just one application. So we're talking 130 million, 140 million ounces out of 1.2 billion ounces. And that's growing. And with all kinds of existing stimulus. I mean, in many countries, first of all, there's a big push for renewables. Many countries, because of the, I guess you'd say, government support for renewables, that makes solar actually the cheapest incremental way to produce electricity. So solar is the cheapest way to produce more electricity. That means more solar panels. That means more silver. And the thrifting, there's been thrifting going on, meaning less silver going into each panel for about the last 10 years, but that's actually leveling off. There's only so much thrifting that you can do. If you see it leveling off, that means they're kind of reaching a bit of a peak in terms of how much they can actually reduce silver content in solar panels. And so, I mean, there's so many layers to this. If you look at the technologies that are coming, the next technology likely to come, and that's perhaps within a year or so, requires 50% more silver per solar panel to get bigger output. And then the technology to follow on that requires 150% more silver to get a little bit more electrical output from a solar panel. Then you layer on top of that things like the International Energy Agency forecasts that by 2030, so that's just 8 years out, that the output of electricity from solar should be up 8.5 times current levels. So if solar requires 12% of all the silver, and you multiply that by 8 or 9 times, solar alone should require all of the silver every year. Obviously, that can't happen. Where does that leave all the other industrial applications, electronics, EVs, medicine, investment, jewelry, silverware? I mean, it's endless, right? So there's one place for the price to go, and that's much, much, much higher. And demand is up. I think it's something like forget. I should check. I have the numbers here. Actually, it's really quite shocking. Physical investment is up 18% over last year in 2022. So I mean, you look at what's happening on the COMEX, you look at what's happening on the LBMA. The silver inventories have come way down. A lot of that is flowing east. We know a lot of it's going to India because they did less buying last year. The silver price was higher. They're definitely big bargain hunters. They see the silver price way down this year. They're absolutely loading up on silver. And so these are all trends that are continuing, and everything, both the industrial, the investment, all these facets of silver demand are certainly pointing to huge future demand for silver. We're finding new applications for it, almost on a daily basis. So the rebound is really going to be very big.
So with these things that are being said, either the miners will have to get more silver out of the ground, or everybody else gets a smaller piece of the pie.
Right. And so that's another really interesting aspect, because silver is very different from other metals, gold and base metals. Only about 25% of the silver comes from primary silver mines. So the other 75% you get from mining other metals. So the 75% of mined silver every year only is a byproduct of mining copper, lead, zinc, and gold. So if you were not mining those other metals, you'd only get 25% of the silver you get every year from primary silver mines. So it depends on what happens with mining these other metals. And let's say you get a slowdown, for example, and then, or, there's all this push against mining and so on. And so if you get a slowdown in approvals of new mines and that kind of thing, and base metals, so copper, lead, and zinc, see fewer new mines come into production, that's automatically going to mean less new silver mined, because 75% of silver comes from mining these other metals. And so it's a perfect storm for silver. You have increasing demand, and you have decreasing supply or extremely limited supply. The only factor that could play a little bit is if prices go, interestingly high enough that you will get more recycling. So you'll get some people will be selling their silver into the recycling market. So that could play, but it's only about 15% of the supply of silver every year. So the effect is really actually quite limited.
Yeah, that's a great point. Just to share, when we got our last batch of gold that came in from Pound Refinery, they had a carbon footprint rating or some
Yes,
kind of a. How are miners going to deal with these carbon issues? I mean, is that going to push up their costs to operate? And of course, that's going to be passed on to us. Where if the spot price doesn't
sure.
move to pick up that price, the premium is going to shoot way up.
Absolutely. Yes, of course, it's going to cost them more. They're going to pass the cost on. There's no question about it. And something that I think a lot of people are not appreciating is that, as much as the intentions might be good, but all of this ESG focus is really pushing costs up for everyone, miners and businesses of all kinds from all sectors. But if you look specifically at mining, traditional banks are being discouraged from lending to what are considered polluting or not industries that are not seen as green or not attractive that way. And so what does that mean? It means their cost of capital goes up. They cannot borrow from the traditional lenders. They have to borrow from new lenders that are in some cases private, that who see increasing demand for their funds, and so are naturally going to start charging more. They're going to start charging higher lending rates to the miners. Again, costs going up, costs being passed on, the metals prices have to go up. So it makes sense for investors to get ahead of these things.
Peter Krauth, before we wrap up, can you tell us about the Silver Stock Investor and how people can follow you and your work?
Sure. So Silver Stock Investor is a newsletter that I started at the beginning of 2021. So it's been running for 2 years. And I cover the entire silver space. It's the only silver newsletter that's focused exclusively on silver. And I talk about everything from physical silver, coins and bars, all the way up from silver ETFs, so silver backed ETFs, and then silver equity ETFs, large producers and royalty companies, and then mid-tiers and developers, and then all the way to junior explorers. So I write this newsletter. It's a twice monthly edition, and you can find out more by going to www.silverstockinvestor.com. You can easily find me on both Twitter and LinkedIn, and it's there's the book, of course, which gives you a great overview of the entire opportunity in silver, the history. And I've written it in what I think is a sort of plain language to make it easy for people. It's not academic. There are lots of charts to explain how my thinking works and what the history has shown us and what the opportunity provides going forward. And so that's available on Amazon, both in Kindle and in paperback.
All right. Thanks again, Peter. Happy New Year.
Same to you, Patrick. Thanks very much.
That was Peter Krauth, author of the bestseller, The Great Silver Bull, sharing his views on silver. To learn more about Peter and follow his work, please visit www.silverstockinvestor.com. If you like this video, please give it a thumbs up, subscribe, and share. We really do appreciate your support. Audio-only versions of this interview can be found on iTunes and Spotify.